Okay. And then you have it on your laptop.
Remind me.
Or just, 1 second, I'm really quickly just gonna
Okay,
finish.
yeah,
Zoom.
sorry, I didn't.
No, you're totally good. Yeah.
There's is it management line?
Yes.
Okay.
We're still chewing through that.
Might-
So Lisa teed up my presentation really well, got me primed with insurance terminology and care plans, et cetera, because we'll be touching on some of here.
Is yours? This one?
That works for me.
Great, okay.
Good, good online. Okay, great. Well, good morning, everyone. My name is Steve Koller. I'm a postdoctoral fellow in climate and housing at Harvard's Joint Center for Housing Studies. Also want to thank the University of Miami because this is the last paper for my dissertation, and they helped support the survey work that I did. The title of the talk is The Willingness to Pay for Vehicle Flood Insurance. So this is a product that does not exist now, but we're exploring some of the demand for vehicle owners to transfer their risks to insurance companies. I want us to shift our focus for the next 15 minutes or so from structures, which are very important, to vehicles. And I'll try to argue why this is important and understudied. I'll zip through some of this since I know there are 5 of us. I had given a snapshot up top. Preaching to the choir here, but we know flooding is costly. It's by many estimates the most frequently occurring natural hazard. So we need to manage risks around flood going forward, especially since anthropogenic climate change impacts are increasing the extent, severity, frequency of flooding in much of the country. At the same time, we know that population growth, urban development patterns are putting more folks and assets in some of these flood-prone areas. So this is one trend around flood hazard that I want folks to focus on. And this intersects with another one, which is around cars. Cars are everywhere, as we know. In 1960, there were about 74 million personal motor vehicles on the road in the US. That number has ballooned to 275 million. In per capita terms, we've also seen growth over that time period with projections for more cars on the road going forward. So lots of flood hazard, lots of cars. How do these two intersect? How do we manage risk given that intersection? And I'll look at this through the lens of insurance. Vehicles, economically important, widely owned. About 87% of households own at least one car. Even among renter households, so those who don't own their primary residence, they own a car. Over 80% of people in the US commute to their place of employment in cars. This is a plot actually from a paper that I presented at this conference in 2023, got published earlier this year, also focused on vehicles and flooding. And this highlights that for some households, vehicles are very financially important. And if you experience an uninsured vehicle flood damage event, that could be a big negative financial shock. So here on the left, we're looking at that big green bar. Among the bottom quartile of households by net worth in the US, vehicle assets owned represent about 40% of the household's total owned assets in dollar value. Whereas as we go to the right, the green bar shrinks. High net worth households own a lot of vehicles in terms of dollar value, but those vehicles represent just a drop in the bucket of their total assets. So if you're low wealth household, you're a renter, you experience flood damage, you don't have insurance, that's a big problem. A little bit more on the policy background and the academic literature background. So you might be wondering, we're at a mobility conference, cars are mobile, can't they just drive away from the flood? They can, but they don't always. So there's evidence here from at least one paper showing that in a case where 88% of homes in a study area were damaged by flood, 55% of vehicles were damaged. So there's some mobility, some adaptation, but not always. My paper that looks at FEMA disaster assistance shows that FEMA has paid out over $160 million in connection with uninsured vehicle flood damages for the data that FEMA have, which are pretty good, but not exhaustive. I know many folks here are interested in the National Flood Insurance Program. You can't cover your car via the NFIP. This creates a number of implications, including data gaps for researchers like myself and many of you who are looking for free publicly available data. We can't go on OpenFEMA and get data on flood losses to cars through FEMA. It's a private market. If you want to cover your car against flooding, you need to purchase a private policy. It's a comprehensive policy, and this is a multi-peril policy. It's optional, not legally required in any US state or territory, though your lender or lessor may require it. So some parallels with what Lisa was talking about. Your mortgage lender will require homeowners insurance. Same deal when you're financing a car. And it covers flooding, fire, a few other perils. The data aren't fantastic, but one estimate I found is that about 1/3 of folks on the road do not have comprehensive coverage, so are not covered against flood or fire. So my main research questions here are, first, what are coastal vehicle owners willing to pay for this hypothetical single peril vehicle flood insurance product? That's number one. Number two, how knowledgeable are folks about what their auto insurance policies actually cover and don't cover? And third, generally, what are the frequency and magnitude of vehicle flood damages? I would love to know this, but the insurance companies I've reached out to have not shared data on this particular aspect of their claims data. So to try to explore this, I collect my own data. I run a survey in 2 states. I'll talk about more in a minute. In general, though, I'm interested in the coastal vehicle owning population and looking down the pike, areas that are expected to experience more chronic flooding going forward, since we might expect to see this, this issue become more prominent with climate impacts. I work with Qualtrics and have a sample frame from their market research panel, and I focus on 39 zip codes in coastal Texas and coastal New York. And it's a web-based survey. So I'll zoom through since there are 5 of us I know presenting. These are the 13 zip codes in New York. They're mostly in and around New York City. And I actually went to high school in 10306 over there on Staten Island, shout out. And then these are the 26 zip codes in Texas, which are concentrated around Houston, Galveston Bay, and Beaumont, Port Arthur. I land at a final sample of about 360 quality responses, depending on your definition of quality. And the summary stats here in the paper, which I'm happy to share, show that it's a fairly representative sample relative to the American Community Survey. And I won't go into this for time, but in general, how do I actually estimate an individual's willingness to pay for this hypothetical product? Well, I give them some text. I say, here are the market conditions. Would you be willing to pay one of those initial amounts on the left amount? They're the leftmost column. They're randomly assigned either an initial bid of $20, $50, $100, or $200. And I say, would you be willing to pay this amount to cover your household's most valuable vehicle against flood hazard for 1 year? And then depending on their response to that first question, they're given a follow-up bid amount. So I do this for all 360 and use a fairly standard econometric approach to make the estimates. So what are the results? I've got this little star on the left. Want us to focus on those leftmost 3 dots, those estimates. The red one corresponds to the sample-wide estimate of an average willingness to pay of about $182 per year to cover the household's most valuable vehicle just against flooding. And the average vehicle value in the sample that we're concerned about is almost $20,000. So same ballpark as Kelley Blue Book average used car sale price. Additionally, when I subset it, just looking at folks who self-report living in FEMA flood zones, they're willing to pay more. They're willing to pay on average, that's that little blue dot, that's folks who are willing to pay on average $244 per year for the product. So they self-report having more objective flood risk. And then the green estimate is $200 per year, and that's folks who self-report being concerned about flooding in their community. So some variation in what folks are willing to pay based on a couple of these factors. Also, descriptive findings. About 1/3 of people in the sample were unaware that comprehensive auto insurance is the policy that covers against flood. So there are consistencies here with the residential side, literature here shown. There are many homeowners who don't know their homeowner's policy does not cover flood, like Lisa was saying. Same deal with auto. And actually, this is a screenshot. I know it's a little small, but I posted a poll in the Whova app and asked folks here about their knowledge about this issue. And as of 9 p.m. last night, of the 19 people who answered and said they own a car, 13 said they don't know if they're covered against flood and fire. So even among this highly expert group of people at this conference, there's still knowledge gaps. And then a second descriptive finding, and it's not a representative sample nationally or even in the study area given the data collection, but more than half of folks said that they've experienced a significant vehicle flood damage events at some point during their time living at that residence. So that was higher than I was expecting. And the average maximum damage that they experienced was almost $10,000 according to their self-reporting. And then this is the last result before getting into conclusions. Here on the x-axis, we're looking at annual household income. I've binned the respondents. As income increases, comprehensive insurance uptake increases as well. So I asked people, how many cars do you have in your house? How many of them have comprehensive insurance, which covers against flood? If you're making more than $250,000 a year, 73% of cars in those households were covered against flood and fire, whereas folks making less than 25,000, only 45%. So the protection gap and that financial vulnerability increases as income decreases. And again, thinking about the most vulnerable folks who might not be able to even access disaster assistance if they're uninsured, and it's a costly event that's not presidentially declared disaster. So some quick policy implications. First, $182 per year was, for that sample-wide estimate, was higher than I was anticipating, honestly, since that's in the same ballpark as what an actual comprehensive policy that's multi-peril goes for on the marketplace in New York and Texas. So there seems to be some demand to transfer risk from coastal vehicle owners to insurance companies around flood. A caveat here, I didn't do sensitivities around deductibles, so would love to do some follow-on and see how that changes the estimates. Also, I know there are experts in the room on flood risk disclosure. Thinking about these knowledge gaps, if let's say someone is registering a vehicle to a house that's in a FEMA flood zone, should there be some sort of disclosure requirement about your insurance policy options that would cover against that flood that you're exposed to? Just a thought. And then last, these are more, I think some of them are a little fun, some of them less so. How will flood hazards intersect in the future with emerging technologies in the auto sector? So electric vehicles, autonomous vehicles, amphibious vehicles, opportunities for risk reduction, but I also think some emergent risks. From a regulatory side, how do we price physical flood peril in auto insurance policies? And then on this issue of the FAIR plan, I've been doing my best to dig into the bulletins from Commissioner Lara in California to try to see what the connections are between emergency assessments, let's say, in the FAIR plan in California after the LA fires and the auto side. Is there potential for costs in the property insurance market to be passed on somehow to folks in the auto side, and might that be regressive? So keeping an eye on that. There are residual markets for auto as well. So I think a lot of parallels we'll be watching to see this market. So that's all I've got. Looking forward to talking and questions down the road. Thanks.
Then do you have any notes?
Hey, everybody, glad to be here. I'm Susan Crawford. I am at the Carnegie Endowment for International Peace. I was a law professor before that. And like all of you, I'm in postgraduate studies about the confluence of risk and property values and where on earth the money's going to come from to help us through an ongoing ferocious transition in our lives. I run a Substack called Moving Day. It's free. Urge you all to subscribe every week. A pungent, readable column about all these things intersecting. So we're exiting stability. Everything we care about is dependent on a stable climate. All of you know this. I'm really interested in what the legal and financial structures are or how they need to change so we can help people survive. We've already talked about this cycle, which looms. And we know, because we're humans, that we'll do everything possible to delay, and then it will be too late. So I'm really interested, as all of you are, in this insurance issue, but I see it differently. Insurers are signals. They're mostly signals. We're muting that signal in all kinds of ways across the country. Our real answer should be to reduce physical risk. Also, on the data point, bravo to those of you trying to do research in this area. We don't know anything really about what's going on. We have a little bit of non-renewal data, but if policymakers knew more about what was happening in their markets, the people planning policy for the city of New York don't know what insurance companies are doing in the city, whether they're raising rates or exiting. We're going to see pockets of property values, probably 20%, sort of a rash of mini global financial crises hitting the US as everything reprices. I got very interested in the infrastructure question. I did a lot of work on fiber optic in my past life, but where's the money come from to relocate, to elevate, to make sure our storm drains can handle things? Right now, 75% of this funding would come from the individual municipal bond market, which is like a lot of used cars. It's this huge thing, really little understood. I'm citing New Jersey right now. There are 546 municipalities. You think every single one of them is going to be able to cope with raising capital, raising debt for itself, especially as flood risk rise? FEMA withdrawal is going to leave states increasingly on their own. So what we really need is a source of low-cost capital. And I've been looking at the state level for this, with clear standards that are funding projects that actually lower risk for people. So I've got some news along these lines. Like, consider the great city of Boston, where I used to live. They have really been working on this. You all know about Climate Ready Boston. They've got 10 years of research. They know that reducing their physical risks will cost about $10 billion. Well, their 5-year capital plan for everything they do, schools, everything else, is $4.5 billion. Where's that money going to come from? They could invest for 10 years on risk reduction, and they still wouldn't have enough money to spend a dime on schools or parking your streets. Last week, Chicago, for the first time since the 30s, experienced a dust storm with a desertification of the Midwest. A cloud of dust just arrived and made it impossible to see. Same thing happened last year. People died on freeways north, Bloomington, Indiana, actually, north of Chicago, when they were driving near trucks and couldn't see where they were going. These risks are hitting cities very quickly. Chicago's deep tunnel was the wonder of the world when it was built to reverse the stream of the Chicago River. It's not enough. Stormwater drainage is not enough. Where's the money going to come from to fix that? So we've got this huge adaptation challenge, which, like all infrastructure, it's extremely expensive upfront, but the long-term benefits serve everybody. It's everyone's problem, and it's no one's responsibility. Very commonly known to all of us. And so we need low-cost money. So I saw, all right, key moment. I happened to talk to the Michael Goggin, who runs the Vermont Bond Bank, just a couple days ago. He says, look at us, we got $250 million in FEMA capital assistance, not debris removal, capital assistance after the big storms over the last couple of years. Our entire debt load for the state is $640 million. That's an extraordinary hole, a big gap. Where's that money going to come from? I also want you to notice that Mr. Trump has saved the tax exemption for bond interest. This is what drives the municipal bond market. Investors have an insatiable appetite for a steady stream of interest payments that are exempt from federal tax. So all high net worth individuals are planning around the bond market. And for the moment, and I write about this quite a bit, credit rating agencies, which otherwise might be doing what Eliza suggests, lowering the ratings for municipal bonds that face physical climate risk, they're not doing it. They're very cautious. So you can get cheap money into the muni bond market, but if you're 546 municipalities, that makes no sense. You really should be aggregating this at the state level. So if you remember one thing from this presentation, this is it. This is my key slide. You can fall asleep after this. What really needs to happen is each state sets up with seed capital, a state revolving fund that can attract even more capital through raising debt through the bond markets. Then that thing, that instrumentality, makes affordable loans for all projects, has to take in a bunch of projects to keep the fund differentiated, but subsidizes or provides particularly low rates for projects meeting rigorous adaptation standards. You're changing your land use, you're not allowing new construction in dangerous areas, you are retrofitting houses, you're really working on it. And the flywheel of this, for those of you who care at all about money, is extraordinary. Think of it as like a savings account for reducing physical climate risk. You get initial funding, it's not going to come from the federal government, but maybe from other actors, maybe from philanthropy, maybe some private equity firms might be interested in this. Then you provide these low interest loans to communities and even lower interest for meeting those tough standards. And as that money is paid back, the fund gets bigger and money goes back into it, allowing it to make even more loans. So who does what? Government's office is going to set the priorities, informed by, and this is really important and doesn't exist in most states, a shared screen, data that everybody understands, that everybody's using for planning across the state. Boy, do we need that. Finance officers then would issue these bonds on top of the capital that's already in, ensuring that money then is directed toward these qualified projects. So here's an example, very small seed, $20 million, comes from somewhere. Maybe there's a match from the state, raise money using bonds, invest the bond proceeds back into the fund to generate interest income. And all of this goes into this revolving loan fund. We've been doing this for years with clean water funds coming from the EPA. Now it's time to do it for adaptation. Run some pilots, should be bipartisan. There is no political valence to this. This is all about material financial risk, not about morality or ESG or anything else. It's just about cheap money for adaptation. So last week, the Illinois Finance Authority managed to get into the budget. The governor will sign, Pritzker is going to sign this, language very broadly defining what it can do for climate resilience. Take a look at this language. Includes, but is not limited to, anything, projects that reduce the potential impact of disasters. That's really something. And it also goes not just to capital like concrete expenditures, buying rivets and steel, but also working capital. So if you need to be paid back for insurance you've had to buy, or you need to pay people's salaries, whatever it is, the Illinois Finance Authority now has the authority to do this throughout the state for any element of local government, which could include a huge span of entities. You think Illinois, wait a minute. They had pension overhangs, they nearly went bankrupt. How could you possibly be talking about Illinois? Well, there's a story of leadership and governance. I think government is good for some things, and this has happened. It's a heroic story. There were 7 different state level financing vehicles that were all consolidated. They created a climate bank back in 21, had the title, didn't have any money. Then they went on, the guy I talked to, Chris Meister, called this a hunting license to become the entity within the Illinois government that went after federal funding. And they went after it, got hundreds of millions of dollars. Hard to get that money to actually flow. And now they're the development finance arm for the state, Illinois Finance Authority, with a very broad resilience mandate. And leadership really matters. It matters that Chris Meister is in place. It matters that he can see around corners and deeply understands the climate risks facing the state. But every state could do this. This is what he's sending this deck around, raising that seed capital. He's setting up a separate vertically integrated structure for state climate adaptation that has some members on its board from the Illinois Finance Authority, some independents. But here's another story. Here's New Mexico. They collect a tax for trash removal and sewage and other things, and 5% of revenues for that is collected every year, and then 75% of that money goes in turn to a revolving fund, this magical flywheel. And they also issue bonds, and then they give loans at 0 to 2% interest to disadvantaged communities. And they can also give a lot of subsidy using this strategy. So taking on debt load is likely the way that cities are going to be able to solve these issues. But if they're in it with everybody, the interest they're paying will be very low. And that's the benefit of having a state guaranteeing these things. The city is not left on its own to try to raise capital. Now, there are definitely pitfalls. You need to keep these revolving loan funds wide open because if you have very bespoke loans, I stood behind a guy at Starbucks this morning and he gave me this example. His coffee was so complicated and it took 4 minutes for the very patient barista to serve it to him. All right, so these loans have to be standardized. And otherwise, they won't be understood by the bond markets because the bond markets are looking for something very straightforward. So although we all have a regulatory mindset, and many of us do, if you put too many constraints on the loans as you're giving them out, it won't work because the flywheel doesn't fly because you can't raise a lot of capital based on it. More pitfalls. You really need to have the finance authority in charge. Only about half of states in the US amplify that seed money with debt, with bond money. A lot of them just don't have the interest in doing it. Why don't they have interest in doing it? Because most of them are regulators. So they're really good at environmental science. Not so good about thinking about the power of money and how it can become a flywheel. In fact, they're likely to say, I think we're over leveraged. And in fact, what they're doing is making capital available to lots of cities. Financial agencies are good at this. They are good at deploying capital. So the strong advice I got was to make sure the finance authority has a hand in this and keeps things standardized as much as possible. So the steps would be to have to tell the governor, we really need this state revolving fund. This is all about the materiality of financial risk. Materiality, I'm afraid to say, not morality, not about ESG. There's so much freak out in this country. I'm sorry to say, climate being viewed as a partisan matter. This gives Trump the freedom to axe NOAA and FEMA. It's all viewed as some wild-eyed, hoax. But in fact, Warren Buffett and lots of people who deal with money do understand physical climate risk, do care about it, and worry about the material risks to the US economy. Create a separate vehicle for the state revolving fund. And then these are natural AAA bond issuances. They're well structured. They're backed by capital. They're very diverse. There's a state match. And investors are blind. They really only care about the high interest payments, which for the moment continue flowing in. Everybody loves the 5% interest that's happening. There are huge bond issuances going on right now all across America, despite all the worries about our economic standing. And then you just every 6 months go back to the capital markets. You're steady. And in Illinois, Meister tells me the credit rating for the Illinois Finance Authority is higher than that for the state. They have sort of proven themselves to be such a good actor that they're constantly able to attract capital. More solutions, keep the window broad. I've said that before. And then subsidize, just as with insurance. We should put the risk on the table. I know affordability is a big issue, but put the risk on the table. Actuarially priced insurance is the only risk signal that's going to help us. Then separate risk from subsidy. If a low-income household can't afford insurance, then subsidize them, but don't pretend that the risk isn't there, because that's what's driving us into this hole that will create a cycle of despair for many American cities. And then use those very low interest loans for qualified adaptation projects. And then this can work. Municipalities will then pay back loans through their tax revenues, which could be a very small amount over lots of years. And based on a very aggregated and diversified risk. Oh, okay, another big idea. I loved it that Lisa had tons of ideas. Cash with optional strings attached. States creates a pool of money, quick state cash through the municipality following extreme weather. This is like parametric, Lisa described. If then the municipality rebuilds, but rebuilds in a more climate sensitive way, relieve them of the burden of the loan. And that's a really interesting idea, and more states should be looking at this. But all of these good ideas depend on capital. You actually need money. And right now, there is a potential source for low-cost capital until the markets wake up and reprice, and then it'll get more expensive. So the huge questions, does any state have a widely shared data picture of its future? I would suggest that very few. There's my alarm going off. What's the measurement of success? Metrics are being developed by New York right now, and also New Jersey's looking at this. Are we setting clear priorities for investment? Are these investments actually implemented? Who pays for them? And then do we disinvest from infrastructure that no longer serves us? Because the charging rhino, this picture I use all the time, is definitely coming in our direction, and it is going to take a lot of preparation. He's just out, maybe he's on 120th Street, but he's coming towards us, and it'll be very surprising and extremely expensive when he gets here. Thank you very much.
Hi, everyone. My name's Nora Schwaller. I'm an assistant professor at UC San Diego. Bring this a little closer. And the project I'm presenting today is on institutional investment in single-family homes after Hurricane Harvey. This session really kind of set me up well because we've been talking about gaps in the insurance industry, gaps in state and city and municipal funding. And this paper is really looking at what happens within those gaps within the private market. So in the aftermath of Hurricane Harvey, there was a lot of news reporting that a bunch of private investors and even individuals were snapping up properties that were flooded and sometimes flipping them or keeping them as a longer term investment. And investors aren't just operating in the aftermath of disasters. They've become an increasingly large share of the single family residential market, starting kind of in the aftermath of the 2008 financial crisis. They became an increasingly large sale of purchasers, and they now purchase between like 15 and 20% of all single family residences in a given quarter or year. Additional context is, as you all know, the cost of disasters are rising, and as shown by Elliott and Howell, or Howell and Elliott, as those costs rise and actually as we continue to invest in post-disaster adaptation, income disparities between white people and Black families increase. So additional FEMA aid is associated with an increased gap in kind of funding for different families. So the research questions I have here are twofold. The first is, does flooding create an increase in institutional investment in single family homes? And does that investment vary by the racial makeup of the neighborhood after storm exposure? So I used two different methods for each of these questions. For the first, the decision to sell, I used a logistic regression, kind of comparing sold versus not sold. For the selling to whom, I subset the data to just the sold properties and use a multinomial logistic regression with the base category of selling to an owner-occupied purchaser versus selling to small and large firms. So starting here, in Harris County, which is essentially Houston, in the aftermath of Hurricane Harvey, there was pretty even distributions between the properties that sold in flooded and non-flooded areas in both white and non-white neighborhoods. So kind of like if you consider that top one is a majority non-white neighborhood and that bottom one is a majority white neighborhood, non-flooded areas at the top row, flooded areas at the bottom row. The proportion didn't really change by flooding for this one, at least not in like a more noticeable way. Using the logistic regression, we did find that once we controlled for socioeconomic variables and pre-existing flood exposure, that if you were in the floodplain, you were more likely to sell in the aftermath of Hurricane Harvey. If you were in a white neighborhood, you were more likely to sell. And if you were exposed to flood and were in a white neighborhood, you are also more likely to sell than kind of a comparative group. But this is the part that I actually am more interested in, this kind of comparative of who we are selling to in the aftermath of flood exposure. So for setting up kind of this sample, we used Harris County Assessor's parcel data. They have annual data going back over a decade, and they have in that kind of the names of the people who own the property, and we use that to identify individual owners versus firms. So first, we kind of like went through it and dropped observations that we thought we couldn't really identify the owner, or we thought they were owned by the state itself. So drop places where their ownership name was like current owner, custodian, Houston, etc. We identified large firms by looking for names that indicated a corporation. So American Associates Bank, Corp, Enterprises, Realty, LLC, etc. And we identified small firms, which we imagine are kind of like more traditional landowners, by people who did not have a corporate name in that category, but also their mailing address was different from the property address itself. And then owner occupied observations were basically who was ever was left. So kind of going back to this, we started here and looked at a selling to whom, subsetting to just the sold properties and looking at who was actually purchasing this data in the aftermath of Hurricane Harvey. And here we start to see differences between flooded and unflooded areas, dependent on the neighborhood that you are in. So kind of using this same graphic, this one's indicating whether or not you sold to an individual owner. So the person who is purchasing it, we assume, lived in the property after they purchased it. You can see in the white neighborhood in particular, there's like about a 20% difference between non-flooded neighborhoods and flooded neighborhoods. So about 80% of properties were sold to owner-occupied and owners in unflooded neighborhoods, and only 60% were sold to owner-occupants in flooded neighborhoods. We did kind of like try to look at some endogeneity concerns. So we took kind of a longer scale look back at properties and what they were, who were purchasing them by the different months, kind of focusing in here just in this aftermath of Hurricane Harvey. This sample is looking at just the population that were flooded and who they sold to. You can see at the top, that's owner-occupied purchasers. There isn't really a big difference in who they were in compared to previous months. Whereas landlords and companies, these small and large firms, you see this like spike for 3 months in the aftermath of the hurricane. So getting into the multinomial logistic regression results, we'll kind of simplify it here to take out the control variables just for looking at them. And I want to highlight a couple of things. The first is that in the aftermath of Hurricane Harvey, flood exposure was associated with increased sales to large and small firms compared to selling to owner-occupied purchasers. On its own, in white neighborhoods, you were less likely to sell to these corporate or institutional investors. You're more likely to sell to a owner-occupied purchaser. However, kind of like at that intersection of flood exposure and being in a white neighborhood, you were much more likely to sell to this corporate investor. I also just want to note that there's also evidence that there was kind of investment in naturally occurring affordable housing during this period by institutional investors. We had the appraisal value, and if the appraisal value was lower, a lower value property, again, more likely to sell to these large firms. Smaller properties were lower likely to sell to these smaller firms. And the older the house was, again, more likely to sell to these institutional investors. These are kind of indicators that would suggest that these properties are more affordable to people. However, they're not being purchased by individuals who will live in them. They're being snapped up by these investors. So the findings that I have here are returning to my research questions. Does flooding create an increase in institutional investment in single-family homes? Yes, institutional investment in single-family homes increases for flooded homes. And is that varying by neighborhoods? Again, yes. Institutional investment in single-family homes increases in white neighborhoods in particular. So there's a lot more research I want to do about why that is occurring, but I have a few theories that I'm hoping to explore further. The first is there's kind of like a cynical interpretation that corporations and investors are taking advantage of homeowners when they're at their lowest. They're snapping up properties when they're very cheap. In Houston in particular, the housing market rebounded really quickly. And there were stories in kind of like like normal newspaper articles, less in academic journals, that were saying that they were holding them and flipping them. Although I guess they could also hold them and rent them out as well. A more generous interpretation is that corporates and investors are providing a necessary lifeline to homeowners who are literally underwater and giving them a way out. This kind of gets to your point about how municipal governments and state governments really do not have the funds to support all of these people who are affected, and there are insurance gaps, and this might be the only way that people can get out from underwater, recoup some of their losses, and move to a less vulnerable area. Both of these narratives are kind of supported within the news reporting that happened in the aftermath of the storm. So there was an article that talked to the James Wade, who was running the buyout program or involved in the buyout program in the aftermath of Hurricane Harvey. And he was noting that we have all these properties, we would love to buy them out. They're hugely vulnerable. We maybe have enough funds to buy out 10% or less. Everyone else is SOL. Adding to this, not captured in this issue, but in work by Greer and Binder, they have found that in the aftermath of Hurricane Harvey in particular, a lot of people who participated in the buyout program dropped out of the program before it was complete. I think probably because they could get equivalent value from the private market. Kind of more reporting here. The journalists spoke with different people who were affected. We have this quote from a woman named Eleanor Moeller. She said she sold her property to a private developer for a decent price, didn't say which. She just said, you know, we couldn't get a government buyout. Our house kept flooding, but it's technically outside of the 100-year floodplain. We are not a priority for the buyout market, and we want to leave. Comparatively, this other woman was asked about her experience. She said that she flooded, her flood insurance couldn't cover the scope of the needed repairs. She didn't really get that much money from FEMA, just a bit over $2 grand. And she still owes a lot of money on the house, but she said that a institutional investor came around, offered under 200 grand, less than her mortgage, less than what it was worth 2 years ago. She was insulted and turned it down. So there's kind of reporting that is showing both that institutional investors can provide a necessary landline for people who are trying to get out, and also that they are trying to act in unscrupulous ways. Which I think I'll be able to give us back a little bit more time. I'm Nora Schwaller, UCSD. I worked with my friend Atticus Jaramillo. He is at the University of Arizona, and Ahmed Rashid El-Khattabi, who is at UNC, my alma mater. Go Tar Heels. Thank you.
10 minutes, maybe the panelists can all come up and we can take questions.
Hello?
Questions.
Hello, everyone. My name is Nicole from Integral Consulting. I'm in the Natural Resource and Environmental Economics group there. I have a question for Lisa. Susan in her presentation talked about the muting of the insurance signal. And I was really curious if you could speak more on your perspective of these alternatives that you came up with and how, in a way, they are actually muting that insurance signal and not necessarily, allowing people to stay affordably in their homes that are in this wildfire urban wildland interface area, which is in a way kind of encouraging repeated loss. And so I was curious, in your opinion, if you had thought about using these alternatives as a transitional measure to, rather than allow people to stay in place, but rather to reduce the shock of a transition from moving one place to another, changing their assets, et cetera, and whether or not you think that could be a trigger-based system or what have you.
I didn't like.
No. Is that on? Okay, great. Good question. Thanks. I think I understand the question, and I'm going to zoom out a little bit. The wildland urban interface, as you mentioned, is the area where we think about homes and properties and private property, especially in the American West, backing up against public land and forested land. And that sort of, we imagine it as a strip. In fact, it's not a strip, it's most of the entire Western US. And so I think, especially here in the East, it's very easy to misimagine what we're talking about when we talk about this risk zone. I lived in Colorado for 25 years, so I speak a little bit from experience. And really, most of the Western states are either big cities or the WUI. You're in the wildland urban interface. So the reality, in the last managed retreat conference 2 years ago, I gave a talk on, is wildfire risk a candidate for a managed retreat or that? And my answer was no, I don't think it is. I think scale is makes it undoable. We can't really imagine everybody across 11 states in the American West all moving. And where would they go? Well, the coasts are not safe. The risk is high there, right? So we're sort of in a world where the idea of a risk-free dwelling doesn't exist. And instead, the way I think about the role of insurance is to buffer and to potentially incentivize mitigation behaviors to reduce risk on site. And that maybe these layered forms of insurance can provide more homeowners with that necessary buffer.
Hi, my name is Bala. I work at UMass Boston in the Sustainable Solutions Lab. My question is also for you, Lisa. I wanted to ask about the voluntary certification program and to what extent it really works in the case of wildfire. Because in the case of flood, if you elevate the house or do something like that, you can reduce the risk to the individual unit. But in the case of wildfire, unless you do a community-wide and a landscape-wide mitigation effort, it doesn't really work, is my understanding. So how can that be made to work? And a connected thing is there a possibility of looking at parametric insurance as a collective thing, and other examples of that? Thank you.
Great, thank you so much. You're absolutely right. I often talk about wildfire mitigation as a collective action problem, right? If you do all this work on your home, you replace your roof, you move your wood pile, you create defensible space, but your neighbors don't do anything, your risk is only a little bit reduced. The number one cause for home loss in a wildfire is not the wildfire, it's embers from the neighboring home. So you're absolutely right that to incentivize an individual to undertake these efforts is less powerful than incentivizing a neighborhood or a whole community. So there's a lot of efforts in place, I think, with that in mind, including things like Firewise communities, right? That sort of seek to incentivize this collective action among communities. When that happens, and we have only at this point anecdotal evidence, but for example, in the Camp Fire in California, where they have the most rigorous building codes in the country, in California, Chapter 7A, they found at Cal Fire, they found that none of the homes that were up to code were destroyed in that fire, right? Now that's anecdotal. So we're still gathering evidence. And when I talked to Jim Webster at Wildfire Partners, which was the example I gave in my slide, he had similar anecdotal evidence. 4 of the houses we treated did not burn in this fire and 10 did. And, so we need better data. We need better information. But you're right, it's not a guarantee. You can do everything right on your home and your neighbors don't, or a catastrophic crown fire comes through and there's really very little homework that could sort of prevent that. I think your second question about parametric insurance at the neighborhood scale is yes, possible. And there are some creative ways that could work. So maybe we can chat about that afterward. Yeah, thanks. Good question.
Hi, thanks. My name is Moira Burse with the Climate and Community Institute. I've also been studying insurance and presented yesterday. I think some folks in the room, I recognize you. And so I actually have 2 questions. The first is following up on the last couple. So I'll say that first, and then the second one is for Stephen. Yeah, following up on that last set of questions and your presentation, Lisa, my colleagues and I have looked at a lot of these questions from an access and affordability perspective as well. And so I guess I wonder if you've thought about the idea of incentives and how well that works for different communities and different households, right? I would imagine that folks with lower income, an incentive may not work as well. And so I'm curious if you've looked into that in your research at all. And then for Stephen, just a knowledge question: is there forced place insurance for auto like there is in home insurance? And just, you can, I guess, explain it, so I'll let you do that. But and then curious in terms of data collection, you said you reached out to insurers themselves and didn't get information. Did you try to collect information from insurance commissioners or insurance departments? I've had some success in that realm and some not success. Some surprising, no, we don't even collect that. So yeah, I'm just curious if you did any of that. Thanks.
I'll speak really quickly to the incentives question, and I'm very happy to hand it off. The incentives are complicated, as you say, because they're sort of income tagged, right? And I didn't do individual primary research on what kind of incentives will motivate people at different income groups. So I can't really speak to that. But in terms of incentivizing mitigation on the property, a lot of work has been going into thinking that through, what kind of incentives are effective. What we find is that insurance companies tend to give really low discounts on premiums for that kind of certification. So it doesn't function that the reduced premium is not a very powerful incentive. However, for homeowners in the highest risk areas who are unable to get insured, if a certification will get them insurance, that's a much more powerful incentive. And that is happening in some places. Insurability is on the table. But I think these are the right questions to ask.
And if they can afford the upgrades anyway.
That's right.
Really interesting questions. So the first one, force-placed insurance. This is something that folks may or may not know about. I did a little bit of exploration on this. There's a great RAND report on it as well, I believe in the flood context. But if you are taking out a mortgage for your home, if you're taking out a loan for your car, and your insurance coverage lapses due to you not paying for your policy, the lender has the incentive and the interest to make sure that the asset is covered by insurance. So they will force insurance onto you by buying it and then billing you for it. And it's typically not as good of a policy, more expensive. So that's force-placed insurance. It does apply in the auto space as it does for buildings. And the second point on data collection, I did reach out to State Farm and a few of the other big players on the auto side, did reach out to the state insurance regulators in Florida, Texas, and New York. Didn't hear back anything substantive. Also went through some data through the National Association of Insurance Commissioners, which is one of these nonprofit groups that coordinates among all the state insurance regulators. And they do have some data on claims payouts for comprehensive insurance policies. But again, this is a multi-peril policy. So I can see in the aggregate in some areas what the comprehensive claims payouts are, but they're not disaggregated by peril. So I don't know, is it flood, is it fire, is it something else? So wish there were better data out there. If there are any folks who know insurance companies who are willing to talk, please reach out.
I think we're at time, but I also think we're all sticking around, so maybe we can have informal Q&A after, but I know some people have to get going. So thanks very much. Great to see everybody.
So my